U.S. inflation for September was 3.0% year-on-year. This was the key number investors watched. It means prices for goods and services were 3.0% higher than they were 1 year ago. For the month of September alone, prices rose by 0.3%. These numbers came from the latest Consumer Price Index, or CPI report. The CPI tracks the average change in prices paid by consumers for a basket of common goods and services. It is the most widely used way to measure inflation and the cost of living. The figures were better than most experts had predicted. Economists were expecting 3.1% year-on-year and 0.4% month-on-month. The actual numbers came in slightly lower, a small difference that surprised financial markets worldwide and hinted that price pressures may be easing faster than thought. The reaction in the U.S. stock market was immediate and powerful. The S&P 500 surged higher. It quickly reached a new all-time high, closing at 6,793 points. The Nasdaq Composite also hit a record, climbing to 22,844.05. These record highs were the direct result of the positive inflation news. The data gave investors a clear reason to buy and push markets to new peaks. This rally was not just limited to the United States. Markets in Europe also cheered the news. The FTSE 100 also rose to a record level, closing at 9,645.62. Positive sentiment was global, as lower U.S. inflation is seen as good for the broader world economy. Before the main stock market even opened, S&P 500 futures jumped by nearly 1%, signaling a strong session ahead. Bond yields fell as investors priced in lower interest rates, aligning stocks and bonds in a brighter outlook. The main reason markets soared is the link between inflation and interest rates. The Federal Reserve aims to keep inflation low and stable. Its main tool is setting interest rates. When inflation is high, the Fed raises rates, making borrowing more expensive to slow the economy and cool prices. When inflation comes in lower than expected, the Fed gets room to cut rates to support growth. After the cool CPI report, markets now price in near certainty of a quarter-point cut at the next meeting. That would lower the benchmark by 0.25%. A rate cut can make it cheaper to borrow for businesses and households, supporting activity and stocks. Softer than expected data settled debate for many, giving the Fed justification to ease without abandoning the inflation fight. Analysts updated forecasts. Many now view a rate cut as highly probable, a potential tailwind for the economy and markets. While the overall inflation number was lower than expected, it is important to look at the details. The biggest contributor to the monthly figure was a sharp increase in gasoline prices. Gasoline jumped by 4.1% during the month. That move noticeably lifted headline CPI. Without the jump in energy costs, the overall reading would have been even lower. Outside energy, price pressures were more muted. Shelter, including rent and housing prices, showed signs of slowing. Transportation services also saw smaller increases. David Russell noted the details are positive, with shelter and transportation moderating. A single volatile component drove much of the monthly increase, while broader categories cooled. The Fed focuses on core inflation. The low core reading suggests fundamental pressures are easing. Within the U.S. market, the rally was not spread evenly. A few large technology companies were responsible for a big portion of the gains. Big tech firms led the move: NVIDIA, Microsoft, Broadcom. These companies have been market leaders all year, driven by demand for AI. Lower rate prospects make future earnings worth more today, especially for growth tech. NVIDIA has stood out as businesses rush for computing power. Microsoft's AI and cloud dominance fueled gains. Broadcom, Oracle, and AMD also benefited, helping lift the S&P 500 and Nasdaq to records. Section 6. London's FTSE 100 joins the record run. Optimism from the U.S. inflation report spread across the Atlantic. The FTSE 100 reached an unprecedented high, with its biggest weekly gain in over 6 months. The FTSE's heavy multinational mix benefits from stronger global growth. Commodity-linked giants in oil and mining helped power the rise. Expectations of U.S. rate cuts can boost demand for oil and industrial metals, lifting profits. Financials rallied too. NatWest gained 4.9% to its highest since 2008 on strong results and upgraded targets. Global optimism plus the FTSE's unique composition amplified the move to record highs. The run underscored interconnected markets and how positive U.S. data can lift indices thousands of miles away. Section 7. Investor mood shifts to optimism. The reaction was a classic risk-on move. Investors were more willing to buy riskier assets and sell safer assets like government bonds. The cooler inflation data provided the trigger. U.S. and European stock indexes soared to new records. The 10-year U.S. Treasury yield fell sharply as investors bought bonds. Stocks and bonds moved together, reinforcing optimism. Michael Pierce said the data likely ensures a Fed rate cut next meeting. David Russell said, inflation might not be slowing, but it's not surprising to the upside anymore. The psychological shift mattered as much as the numbers. Section 8. Lingering risks on the horizon. Inflation at 3.0% is still above the Fed's 2% target. The central bank needs continued progress before declaring victory. A re-acceleration could delay planned cuts. The Fed could even consider raising rates again. That would be a major shock to markets. Policy risks like tariffs could trigger another round of painful inflation. Tariffs are taxes that can directly raise consumer prices. The labor market shows signs of cooling, complicating policy choices. Energy prices remain volatile and sensitive to geopolitics. One good report is just one data point. The road to stable, low inflation is rarely straight. Section 9. The path forward. What to watch now. Markets reacted immediately to cooler September inflation. Data was a pleasant surprise. Headline and core inflation fell. One report pushed major indexes to record highs. The reason? Belief the Fed can start cutting rates. Markets expect a 0.25% cut soon. That expectation fueled a risk-on rally. Most immediate, the Fed's next decision and statement language. Any deviation could spark big volatility. Watch U.S. jobs data, the other half of the Fed's puzzle. Monitor energy price volatility and corporate earnings, especially whether gains broaden beyond big tech.